Ever walk past a store with an amazing 30% off sale that nobody seems to notice? That's exactly what's happening with Starhill Global REIT right now in the Singapore market. It's trading at a massive 30% discount to its book value while offering yields above 7%. Yet most investors are walking right past this potential opportunity. Today, I'm going to show you why analyst Vijay Natarajan from RHB Bank Singapore calls this REIT underappreciated, despite its steady performance over the last 5 years. And when everyone's worried about retail REITs in an e-commerce world, could Starhill be the contrarian play that smart investors are missing? I've been analyzing REITs for years, and what caught my attention here was not just the high yield, but how management has navigated challenging retail environments while maintaining a conservative financial approach. The numbers we'll look at today come directly from RHB's April 2025 analysis, giving us fresh insights into this potential opportunity. In this video, we'll explore why Starhill Global REIT might deserve a second look, breaking down its portfolio structure, financial position, and what makes it uniquely positioned in today's market. Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 850,000 reads and 53,000 likes. I've produced over 700 videos with more than 300,000 watch hours as of December 2024. I also focus on regional and world economy topics. Let's start with understanding what makes Starhill Global REIT interesting in today's market. The REIT has been delivering steady operational performance over the last 5 years, despite facing what RHB analyst Vijay Natarajan describes as a challenging environment. That's like maintaining your jogging pace while running uphill. Not flashy, but impressive when you think about it. What exactly is Starhill Global REIT? For those unfamiliar, it's a Singapore-based REIT that owns retail and office properties primarily in Singapore, Malaysia, Australia, and Japan. Their flagship properties include stakes in Ngee City and Wisma Atria on Singapore's prime Orchard Road shopping belt. Have you ever noticed how some businesses thrive, not because they're the flashiest, but because they consistently execute their strategy well? That's the story here with Starhill. One of the REIT's key strengths is its balanced portfolio approach. Unlike some REITs that are all in on a single strategy, Starhill maintains a mix of master leases and actively managed properties. Think of it like diversifying your investments rather than putting all your eggs in one basket. Master leases provide stability. They're like having long-term tenants who pay rent regardless of how their business performs. The actively managed portion allows Starhill to capture upside when retail performs well. This balanced approach has helped the REIT weather retail storms that have capsized other retail property owners. Let me give you a simple example of how this works. Imagine you own 2 rental houses. For one house, you sign a 10-year lease with a family at a fixed rate. That's your stability. For the other house, you rent it out at market rates that can go up or down. That's your opportunity for growth. Starhill essentially does this at a much larger scale with commercial properties. What does this balanced approach mean for you as a potential investor? It means lower volatility in dividend payments compared to purely actively managed retail REITs. In uncertain retail environments, wouldn't you prefer some certainty in your investment returns? Speaking of management, let's talk about their capital strategy. The analyst report specifically mentions that management has been prudent on capital management, keeping gearing below 40% and refraining from acquisitions. Gearing is essentially how much debt the REIT has relative to its assets. A gearing ratio below 40% is considered conservative in the REIT world. Think of it like buying a house with a 60% down payment instead of the minimum 20%. You have much more cushion if property values decline and your monthly payments are more manageable. This conservative approach means Starhill has financial flexibility. If great acquisition opportunities arise, they have the capacity to take on more debt. If interest rates rise further, they're less vulnerable than highly leveraged competitors. In uncertain times, wouldn't you prefer investing in businesses that maintain financial flexibility? The restraint from making acquisitions is also telling. In the REIT world, there's often pressure to grow bigger through acquisitions, but smart managers know that making no deal is better than making a bad deal. By refraining from acquisitions in what might be an overpriced market, management is demonstrating discipline, a quality you want in the people managing your investment. Now, let's address what many investors are concerned about: the evolving retail landscape. E-commerce has undeniably changed retail, and COVID-19 accelerated many of these trends. However, the analyst report suggests Starhill remains well poised to navigate these changes. How? The balanced portfolio mix we discussed earlier is part of the answer. Additionally, Starhill's properties tend to be in prime locations that continue to draw traffic. Premium retail experiences still attract consumers, even in an age of online shopping. Think about it. People still want to try on luxury goods, experience restaurants, and enjoy social shopping experiences that can't be replicated online. Have you noticed how some of the most successful online brands like Apple and Tesla still invest heavily in physical retail locations? That's because the right physical presence still matters enormously to the overall brand experience. Starhill's prime properties can capitalize on this continued demand for quality retail space. Now let's talk about what really jumps out from the analyst report. Starhill is trading at approximately 30% below its book value. In simple terms, you're buying $1 worth of assets for around 70 cents. That's like finding a designer watch at a thrift store priced well below its actual value. But wait, is this discount justified? Are the properties overvalued on the books? According to RHB's analysis, this discount appears unwarranted given the REIT's steady operational performance. The market seems to be pricing in concerns about retail that may be overblown for Starhill's specific portfolio. When we see assets trading significantly below book value, it's always worth asking, what does the market know that I don't? Or alternatively, what is the market missing that creates this opportunity? In Starhill's case, the discount likely reflects general concerns about retail properties in an e-commerce world, alongside potential worries about interest rates and property valuations. However, not all retail is created equal. Prime locations like Orchard Road in Singapore continue to command premium values and remain resilient. Let's dive deeper into what makes Starhill Global REIT's portfolio structure uniquely positioned in today's retail landscape. Unlike many retail REITs that focus exclusively on shopping malls, Starhill has a more diversified approach. Their properties span multiple countries, including Singapore, Malaysia, Australia, and Japan, providing geographical diversification that can help buffer against localized economic downturns. When we look at Singapore specifically, the REIT's crown jewels are its interests in Ngee City and Wisma Atria on Orchard Road. If you're not familiar with Singapore, imagine these as being equivalent to owning retail space on New York's Fifth Avenue or London's Oxford Street. These are irreplaceable locations that continue to command premium values regardless of retail trends. Think about location value this way. No matter how e-commerce evolves, certain physical locations maintain their intrinsic value because of foot traffic, prestige, and the shopping experience they offer. Orchard Road is Singapore's premier shopping destination, attracting both locals and tourists. Even as retail evolves, prime locations like this adapt rather than decline. Another significant advantage mentioned in the report is strong sponsor support. Starhill Global REIT's sponsor is the YTL Group, a major Malaysian conglomerate with diverse business interests. Having a financially strong sponsor is like having a rich uncle who can help you out if times get tough. The sponsor relationship provides multiple benefits. First, it can offer financial support during challenging periods. Second, it can provide a pipeline of potential property acquisitions. Third, it adds credibility and stability to the REIT's operations. When evaluating REITs, sponsor quality should always be a consideration, and Starhill seems to check this box. How does this sponsor relationship translate to real benefits for investors? During economic downturns, REITs with strong sponsors typically have better access to capital and more options to navigate difficulties. They're less likely to be forced into distressed property sales or dividend cuts. For you as an investor, this means lower risk and potentially more stable returns through market cycles. The second major highlight is the dividend yield of over 7%. In today's market, that's substantial. To put this in perspective, the average Singapore REIT yield is around 5 to 6%, while bank fixed deposits might give you 3 to 4%. Government bonds aren't much better. A 7% yield gives you significant income while you wait for any potential price appreciation. But high yields can sometimes be warning signs. Does this high yield indicate higher risk? Based on RHB's analysis, Starhill's yield appears sustainable, given its operational performance and conservative financial management. The REIT has demonstrated consistency in maintaining its distributions through challenging periods. Think about yield like this. If you invest $10,000 in Starhill at a 7% yield, you're getting about $700 per year in distributions. That's meaningful passive income, especially compared to other investment options available today. Let's break down what a 7% plus yield means in practical terms. If you invested $50,000 in Starhill at current prices, you'd receive approximately $3,500 in annual distributions. That's around $290 per month in passive income. How does this compare to other income-generating investments available today? Singapore government 10-year bonds yield around 3.54%. Bank fixed deposits might offer 4.5%. Other Singapore REITs typically yield 6.5%. With Starhill offering 7% plus, you're getting a yield premium of at least 0.52% compared to other REITs and 3.5% compared to risk-free government bonds. This yield difference might not sound dramatic, but it compounds significantly over time. For example, $50,000 invested at 7% versus 5% for 10 years, assuming reinvestment, results in approximately $98,000 versus $81,500. A difference of $16,500 or 33% more wealth created just from the higher starting yield. Have you noticed how the most successful long-term investors often shine not by what they do, but by what they refrain from doing? Warren Buffett is famous for his patience and willingness to wait for the right opportunities. Starhill's management appears to be exercising similar discipline. Let's explore another aspect of Starhill's value proposition, its potential role in a diversified portfolio. REITs generally serve as income-generating assets with some inflation protection, since property values and rents tend to rise with inflation over time. They typically have lower correlation with stocks and bonds, potentially improving portfolio diversification. Within a REIT portfolio, Starhill offers exposure to retail with a conservative twist. The balance of master leases provides stability, while the actively managed portions offer growth potential. This positioning is somewhat unique in the Singapore REIT landscape. If you're constructing an income portfolio, how might Starhill fit? Consider it alongside industrial REITs, which tend to be more e-commerce resistant. Office REITs, which face work-from-home headwinds but offer higher yields. And specialized REITs like healthcare or data centers, which offer exposure to structural growth trends. Before we move to our conclusion, let's summarize the investment case for Starhill Global REIT in the context of today's market. Valuation: trading at a 30% discount to book value, offering potential for capital appreciation if the valuation gap narrows. Income: providing a 7% plus distribution yield, meaningfully above alternative income investments. Stability: balanced portfolio with master leases providing income predictability, financial strength, conservative gearing below 40%, providing a buffer against market volatility, management quality, demonstrated discipline in capital management and operations, sponsor support, backed by YTL Group, providing additional stability and growth options. Against these positives, investors should weigh the ongoing structural challenges facing retail properties, potential interest rate pressures, and macroeconomic uncertainties. However, at current valuations, much of this risk appears to be priced in, potentially creating an attractive risk-reward proposition for income-focused investors. Before making any investment decision, you should conduct your own research beyond this single analyst report. Look at the REIT's latest financial results, property portfolio, tenant mix, and debt maturity profile. Compare it with other Singapore REITs to ensure you're getting good relative value. If you're considering adding Starhill to your portfolio, think about your overall allocation to REITs and to the retail sector specifically. Diversification remains important even when individual opportunities look attractive. If you found this analysis helpful, please hit the like button and subscribe to the channel for more Singapore and regional investment insights. Drop a comment below sharing your thoughts on Starhill or other REITs you'd like me to cover in future videos.